Personal finance tips. You know, there's a common lament, and rightly so, that a lot of people know a lot of stuff about a lot of stuff, but they many times don't know how to manage their personal affairs financially. A really good place to start is proper loan and investment payment priorities. And a lot of bad advice out there. Rich dad, poor dad says pay the debts off first. Oh, no. Wouldn't you like to borrow at 2%, invest at 10? Here we got 4 loans and 4 investments. Actually, we're going to see the home kind of as a little bit of both. Let's start with a credit card. Let's say it's 20%. No tax deduction for the last couple of decades. It's the same 20% after tax. Auto loan, same thing. Maybe it's 7%. Now, let's say you have a student loan, say at 9%. Some of them can be forgiven, and maybe there's some rules on that and limitations. And also the deductibility can be problematic with the new limit of $10,000 on the standard deduction. But in any case, let's do it after tax for a Californian, highest in the nation, which amounts to 1/3. After tax, that 9 becomes 6. Well, the next one's the home. The first 2 get a full tax deduction, and say it's 6%, that'd be 4% thereafter. And it is kind of an investment also, noting you get a quarter or a $500,000 exclusion from a one-time capital gain for singles and marrieds. On the investment side is your personal cash account, normally fully taxable. Let's say you make 12% in the market, that'd be 8% thereafter. But there is an advantage unique to that account only, and that is you can save an additional 9%, middle income brackets, if you have qualified USA stock dividends and or capital gains. That instead would get you to maybe 9 instead of 8%. Then we have the IRA accounts. A stands for arrangement. First we have the tax-free Roth. So before and after tax it remains unchanged at 12. Then there's the traditional IRA account. And unlike Ed Slott, I'm not so sure that this is one that you probably don't want to consider. We'll do the math in a moment, but the ending tax rate, if it's the same, well, actually, it's a wash. And if the ending tax rate is lower, which is very likely if you move out of California or you have low income at the end, the traditional actually gives you a better return, albeit on a smaller net amount. Then we come to the pension, 401k corporate, 403b nonprofit, and here the tax is deferred. And even if you don't get the free matching from the employer, still a good idea because of that deferral. Now, in this example, we have 12% in 12 years. Turns out that will be worth 1/4 as much, so we adjusted therefore. It ends up being worth 11%. Now, let's rank these by the after-tax rate, not by the size of the account or the amount of the payments. That's Susie Orman's snowball approach. Not bad, get started, but still, look at this ranking. Pay off that credit card. Number 2, one of those IRA accounts. Number 3, go to the pension. And don't forget, even more so if they give you free money. 4, your personal cash account. Then 5, then pay off your auto loan. 6, your student loan. And finally, home payments come last. Here's a good place to be reminded that the sooner you start, the more you'll have at the end. If you start 10 years earlier, 30 versus 40 years, you double it. Using a no-load, low-expense ratio mutual fund, index if you will, maybe saving 2%, doubles it again. Well, in terms of feasibility, with currently the amount of $7,000 max, $8,000 if you're over 50 for either the IRA accounts, that, that's about $12 a day for the traditional, $18 a day for the Roth. And here's the math for why they get roughly the same return, unless the tax rate's lower at the end, in which case you'd actually prefer the traditional. Oh, by the way, notice that the Roth does set aside 50% more. Well, while Susie Orman and a lot of others say wait to collect your Social Security because it does get a little bit bigger the more you wait, look at the present value alone says take it at the current age of 67 and you're more likely to able to enjoy it. And don't forget that long longevity. And little tip, the last 10 years is how they calculate it. So be aware of that. With regard to insurance, as a rule of thumb, don't buy any warranties and minimize what coverage you have. And if you had to choose between deductibles, you take the difference in the deductibles divided by the premiums and you get a longevity measure. Usually you want a higher deductible with a lower premium. You want to get term life, not whole. Don't get it for the kids. Avoid those annuities. And by the way, contrary to some, your debts, if you pass, usually do not pass on to relatives unless they co-signed it. Here's my special tip for buying stuff. How about spend a half hour for each $1,000 purchase? You save 5% maybe, and that's $100 an hour. Cars, see the April issue of Consumers Reports. For real estate, you gotta get a realtor to access the multiple listing service. Don't think of collectibles as an investment. Think of it as enjoyment, and turns out that's the best ones. A certificate of authenticity, forget about it. Avoid those lotteries and gambling, as tempting as they may be. For one thing, a lot of people don't handle that kind of wealth. And secondly, if you took the monies, done a study, that if you invested it, you'd have $1 million at the end instead of losing on average of about $50,000. And while noting this is for academic purposes, in California, an account beneficiary usually supersedes a will and minimizes probate. Here's a tip. Distribute stuff while you're alive and you settle the arguments. You get to see them enjoy it. Finally, there is no required minimum distribution, currently starting at the age of 73. Noting that you're taxed on the full amount and it's a small amount at the beginning, and it turns out the effect upon your account will be such that even if you only made a 4% return, you're still going to get increasing payments for the next couple of decades. It's done by a chart. Here's the chart. It's going to change probably by the time you get there with Dr. C Invests.